Welcome to Investing in Tomorrow, exploring opportunities in opportunity zones. Go ahead, Marie.
I'm Marie O'Neill. I am a tax director here with Cherry Bekaert, working out of the Atlanta office. I specialize in real estate structures of all sorts, and I am also supporting Kat as her opportunity zone clientele grows and grows.
And I am Catherine Bazley, Kat. I am a tax partner in Cherry Bekaert's Atlanta office, and very, very heavily involved in real estate. And just a little overview on Cherry Bekaert. We are a full service accounting and advisory firm. We offer the standard audit and tax services, as well as basically any kind of consulting that you could possibly imagine: software selection, site selection, credits and incentives, cost segregation, converting your financials, to GAAP, or if you have another need. So you name it, we can probably do it. But Marie and I like to stay in our lane and focus on tax, specifically real estate tax related items. That's why we're here today.
So just to go through our agenda for today, we're going to just give a quick overview of qualified opportunity funds and then qualified opportunity zone businesses, just so as we're giving our, kind of talking more in depth, the terms have been introduced, et cetera, so we're all on the same page. Then we'll go through, some 3 different sectors of investing that can be done in opportunity zones, and a little bit of comparison and examples of those 3 sectors. So to start us off, Kat, can you just kind of walk us through qualified opportunity funds and then qualified opportunity zone businesses?
Sure. And again, just kind of a quick refresher for all of you. We're not entirely sure what was covered in the previous session, but the Qualified Opportunity Fund, the QOF, is the investment vehicle that is organized as a taxable entity. It must be a corporation or a partnership for the purpose of investing in opportunity zones. And the opportunity zones were created as a way to reinvigorate and infuse capital into some kind of more depressed areas. And it really has been, if you kind of review new markets or low income, it follows some of those same concepts. But the QOF must hold at least 90% of its assets in QOZ property. A requirement of the QOF is it is something that is self-certified, which is a little bit unique, by the taxpayer, and that self-certification is done by submitting Form 8996, which is a form that goes within the tax return. And then there's actually a box on the tax return where you have a question that says, are you a qualified opportunity zone? If so, complete Form 8996. That needs to be checked as well. Just as a little side note, that is something that's one of the real life situations where folks have come to us because that has been an error made by someone else. And very importantly, again, this has come up quite a bit, is a fund cannot invest in other funds. A lot of people think, well, I'm going to structure this fund and find these other funds that sound really good, or I like the idea of this, but I want to create my own fund. A fund cannot invest in other funds. That is critical to know. And just in general, like, what is a qualified opportunity zone? We talked about that. I just talked about it a little bit, but it's a census tract that meets the definition of a low-income community, and it was specifically designated through the QOZ process. So each state worked to determine their own, and each state's governors actually made the decision as to which ones would qualify, which is why there's some areas that might look a little, you might look at them and say, really, that's an opportunity zone? But it is, and it will stay that designation for at least 10 years. So it is something that's quite favorable. There's a lot of opportunity zones that are in areas that I think would surprise some people. Here in town, in Atlanta, Georgia Tech is not far from our office, and there's actually a lot of opportunity zones right around Georgia Tech. There's actually a lot of opportunity zones around college campuses. I mean, we're actually going to talk about that a little bit later with some of our examples. But so that's what an opportunity zone is. Okay, and remember that an opportunity zone fund, the QOF, must deploy 90% of its assets into qualified opportunity zone property. And the property can consist of three separate things. It could be QOZ stock, which is stock in a domestic corporation. It has to have been acquired after December 31st of 2017. Original issue has to be acquired for cash, and it was a QOZ business when the stock was issued and during substantially all of the QOF's holding period. I heard a little bit of the last presenter's comments, and he actually addressed this when he was talking about the 90% holding period. So that is, he is correct. That is crucial. You want to ensure that whatever your QOF or QOZB property is, that it is held for the 90% holding period, or you will have a problem at your fund level. Another type of property is a partnership interest. That is what we are seeing to be most common. It's the tiered structure where you have the QOF as a partnership and then the QOZB as a partnership underneath it. And that is for capital or profits in a partnership. Again, acquired after December 31st, 2017 at original issue and for cash, and same holding period issues. And finally, the QOZB business property. And that is something that it can get a little confusing, because it can either be business property that is held directly by the QOF, or it can be business property that is held within the entity below, which is the QOZ Corp, where you have the stock, or the QOZB partnership, which holds the partnership interest. And that you must have tangible property used in a trade or business in an opportunity zone. It must be acquired after December 31st, 2017. Original use, and then substantially all of the property is in use in the zone for substantially all of the holding period. And one of the things that we see is, yes, the QOF can hold, as we're outlining right here, the QOF can hold the business property directly, but it is a bit riskier. Whenever possible, we do advise that you have the tiered structure, because the working capital safe harbor, which is something that many people rely on, and it is phenomenal, and it allows for a lot of flexibility, that doesn't exist at the fund level. It only exists at the business level, which is a separate one. And then we'll kind of get into some of the issues that we've seen with that in the examples.
And so I'm going to stop here for two questions that have come into our chat that
Okay.
on items we've already addressed. First one, I understand that a QOF cannot invest into another QOF, but can a QOZB invest in another QOZB? Or alternatively, can two QOZBs invest in the same piece of land as part of a housing development?
The second, yes. And that is actually common. And what, let's say you have this piece of land and QOZB puts, owns 50%, the other QOZB owns 50%, that work. Another thing that we see quite often is, since the QOF can't invest in another QF, very common. Let's say you have a fund, a $50 million fund, and somebody comes in and says, I want to put 10 million in, but I don't want to pay the management fees. I don't want to be part of your fund. So what many sponsors will do is they will allow that $10 million investor to come in as a sidecar investor. So rather than have their QOF sitting on top of the QOZB, they have their QOF, and then this sidecar $10 million investor who has their own QOF invest directly into it. So you can do that, and you just want to make sure that everybody at their own fund is responsible for the testing, and then the underlying business would be responsible for the reporting information and the holding period that will keep the QOF compliant.
The next question, we bought a property in an opportunity zone on campus. It was an apartment building. Does that qualify as opportunity zone property because it is in an OZ?
Okay, that one is something that where it gets a little bit tricky, and we were going to talk about it a little bit more later, but this is a perfect time. So what a lot of people are doing is saying, okay, I see this piece of property, I know it's in an OZ, this will be a great investment, and they'll buy it. Well, the problem is if it is not bought in the proper structure, that could be an issue. If it is not bought with a qualifying investment. So the qualifying, let's say you have the structure set up perfectly. You've got the QOF and where you've raised money, you have the partnership, the QOZB that's going to buy the apartment. Fantastic. The investors in the QOF, if you want to be able to get OZ benefits at your 10-year exit, those investments have to have come in with capital gains. So quite often we see someone that has identified a property and they say, great, I'm going to buy this. And they didn't purchase it either via the correct structure, that happens quite often, but they also didn't make a qualifying investment with capital gains. So if you just, if you use your W-2 income to buy this property, that will cause a problem. If you have capital gains and then you supplement that with debt, that is fine. But you do need those capital gains in order to get that benefit later. And then the third point that you need to consider is you have the apartment building, you have to do substantial improvement. You can't just buy something and just keep it moving right along as if it's always been. So what I would recommend, and I think the last presenter touched on this a little bit, is let's say you have an apartment building, you pay $3 million. I would get an appraisal done to determine how much is land versus how much is building. If it's in an opportunity zone, well, if it was in the early years of an opportunity zone, the chances are the building needs a good bit of work. Most of the value will be in the land. And let's say in our $3 million example, you get someone to come in and say, you know what, the value really here is in the land. The value is in the land. The land is worth $2 million. Your building's worth $1 million. That means you only need to put in another $1 million to substantially improve that property. If you do not get the appraisal done, I mean, I don't know how you would substantiate that you don't need to fully improve the $3 million purchase price. Obviously there's an argument that there's value to the land no matter what. I would get that appraisal and be safe. But you will have to make those substantial improvements. So it's not just quite as simple as buying an apartment building in an OZ. But we love these questions, so keep them coming.
Yeah.
Makes it more interesting, I think, to everybody.
Yeah. Okay, so now that we've kind of gone through qualified opportunity zones and qualified opportunity funds, can we discuss qualified opportunity zone business, basically?
Yes. So historically, like when the program first started, and maybe it's because our line of work is really focused around real estate, but so many of the projects that we saw initially were real estate focused. And that's easy. You have a piece of land or a property, you're making improvements, that's really all the business holds. It's easy to understand that test. But for a trader business, it substantially all, which is the term substantially all means at least 70% of the tangible property that is owned or leased is in the OZ zone, and that's used for the business is in the OZ zone. At least 50% of the gross income is from an active trader business. So think about what that means. It's from an active trader business. You can't just, and 70% of the tangible property. You can't invest and just live off dividends, interest, capital gains. That is not the intent of these programs. So a substantial portion of the intangible property is used in the active trader business. And less than 5%, this is a big one, less than 5% of the average aggregate adjusted basis of property attributed to non-qualified financial property. Less than 5% can be non-qualified financial property. and that I'll come back to that in a little bit. But and then I think everybody knows this just because it's rather entertaining. No portion of it can be used in the sin business. So interesting how they decided what's a sin business versus not, but that's one of the rules. But kind of getting back to that non-qualified financial property, that is something we actually get a lot of questions about. A lot of times people will say, hey, I've set up my quaff. Let's use 10 million to make life easy. I've set up my quaff. I immediately deployed, or within the after my 6-month holding period or 6-month exemption period, deployed my 90%. So I put 90% into my separate LLC, which is a QOZB. $9 million was invested there. And a lot of times, let's say it's either ground up construction or substantial rehab. You're not going to immediately deploy $9 million. If you are, your contractors are going to love you because you're prepaying them $9 million. But most people won't be doing that. So a lot of people are saying, okay, yeah, I've got that 9 million. Can I loan it and make loan to some of my related party entities? I'll still put an arm's length interest rate in place. Or can I, invest it or even be safe and put it in CDs? So this is where it gets a little bit tricky, because non-qualified financial property has to be an asset that is held 18 months or less. So you can't invest in a 24-month CD. You've got to be very careful there. You can make a loan, even though that would be considered non-qualified financial property, but then I wouldn't even push it to 18 months. The few folks that I have kind of given the okay to do that to, I've said make it a 12-month loan, because life happens. You never know what might happen. You don't want to risk hitting that 18 months and have a non-qualifying asset. So just something to keep in mind. Something else to keep in mind here is that interest that is earned, you have your 9 million, let's say you immediately deploy 3 million and buy the land, and you have 6 million that's sitting there. Interest that is owned at the QOZB level is allowed. That is fine, no problems. At the QAF level, where you originally raised 10 million, interest can be a problem. So let's say you raised 10 million at your upper tier, at your QAF, you deployed 9 million, which was your 90%, and your $1 million is sitting there earning interest, and you've had very few expenses. This has actually happened to a client. They earned interest and just nothing fancy, no CDs, nothing fancy, but they earned interest, and that actually threw them out of compliance. They were fine. We were able to remedy things, but because they were at 89% of their assets were deployed to qualifying business property. So just be aware of that. You can pay your CPAs and your attorneys to get that cash balance down before you're testing, but just something to think about, that yes, you can earn interest as part of your working capital safe harbor at the QOZB level, but you can't at the QAF level.
We've only got about 5 minutes before our break, but if we can address in that time some of our safe harbor testing.
Okay. So the safe harbor testing is what comes into play when you have a business in the QOZ, it's your QOZB business. And that's because, with real estate, it's easy to determine if you've made substantial improvements. But how do you really judge an operating business? How do you determine if a laundromat, is qualifying? And that's where the 50% gross income safe harbor test comes in. And this says that in order for your business, which is a corporation or a partnership, to be considered in the active conduct of a trade or business in an opportunity zone, at least 50% of its gross revenue must be generated in that zone. And then just to kind of further delve into that, well, how do you determine that? So there's employee hours, because a lot of times, think about startup businesses. You might not have much revenue in year one. You're just trying to get things up and running. So employee hours, it's a great way. 50% or more of the employee hours, partner hours, and independent contractor hours are performed in that opportunity zone. Employee wages follows along with hours. 50% or more are for services performed in that opportunity zone. Tangible property. 50% or more of the gross income that is generated by tangible property that's used in that active trader business and the management or business functions of that business are performed in that opportunity zone. And then, 50% of the income. So that's where you have a lot of flexibility to meet your safe harbor tests to determine if you have a qualifying active trader business.
We're going to spend the second half of this session going into some different opportunities for investing in opportunity zones. And to start off, we will look at different real estate opportunities. Kat?
So real estate, there's a reason real estate was kind of the hot topic when these first came out, because a real estate investment is very well suited for this type of program. You are able to identify a project. You are able to deploy a substantial amount of capital within a relatively short window. Most development projects, are phased and have a dedicated timeline. There is a predictability of capital that is needed. The 10-year hold for your OZ investments works very, very well with real estate. And there you are able to generate, to take on debt at the QOZB level that if needed, and if it's structured correctly, we have to be very careful about that. But there are ways that you can use debt to get cash back into the hands of your investors that can help offset the tax that will be due in 2026. Some things to consider when making a real estate investment. Well, with any of the options that we're going to talk about, the investment should be a solid investment on its own. The tax benefits should not be the reason to make the investment. Like everything, some of these investments will not really amount to what they hoped. So look at it as, in the same manner you would a regular real estate investment or, an active trader business, whatever it may be, and the tax benefits are kind of the gravy on top. Another consideration to keep in mind in evaluating these real estate projects is a lot of these areas, the local governments of these designated zones are very excited about the opportunities, and I hate that that's the word, but about the opportunities and options that are available to them because of these zones. They're seeing the infusion of capital. So they're doing what they can to encourage investors and developers to come in. And we're seeing a lot of, some, freezing of property taxes or abatements of property taxes and helping the permitting process along because these local areas are really excited about the opportunities here. Another area that kind of lends real estate to fitting this program so well is most of the projects that I've seen. I think all of the projects I've seen, I'm sure there's some that don't, but most have, a construction plan or, some type of dedicated timeline. And that is crucial for these opportunity zones. For the working capital safe harbor, you need a written plan. Well, most developers already have that. They're saying, okay, these first 3 months, it's going to, be all of the planning and the zoning, et cetera. The construction at this time, looking to get your CO at another time at this particular endpoint and, lease up. So that lends itself very, very well to the working capital safe harbor provision that is part of the opportunity zone business.
Can you give us a couple of examples of what you've seen with clients with some of these real estate development projects in OZs?
So I've seen ground up, which, as I explained in the beginning, ground up, you're just dealing with land. And the first dollar you spend is substantial improvement. So that's nice and easy. I have seen the existing structures where, they are coming in and they are doing substantial improvements. And again, that's where you want to get an appraisal and make sure you separate the value of the land versus the existing structure. I'm seeing, I would say probably the asset classes that I am seeing most are workforce housing and multifamily. I've seen, especially with the workforce housing, local governments are really, really, really invested in bringing in more workforce housing to certain areas. Like in Florida, we have a client that there are a lot of distribution centers that are being set up in a particular area and kind of in central Florida, but there are no housing options. So, the local governments are working with a developer to put in some workforce housing. They're offering a ground lease, they're offering some very favorable bond incentives. So it is nice to see kind of all of this come together.
Gotcha. And what about like small businesses? Separate from real estate, where are you like seeing small businesses pros and cons within the opportunity zone structure?
So that one's a little bit trickier, because real estate, it's the easy test. So you can easily figure out if you're substantially improving the land. With small businesses, one of the challenges we're seeing is somebody's like tech companies. Let's say they're, three guys are going together, they're starting a tech company with sweat equity. Well, that is not going to be a qualifying investment. You need a capital gain that's going to be that qualifying investment. So yes, they can start a business in an opportunity zone, and maybe they bring in some investors that have qualifying investments, set up the fund, do the two-tier structure, please. But, and that's great. But those three guys that founded the company, or gals, with sweat equity will not get the OZ benefits after the 10-year hold. And I think that is something that has caused quite a bit of confusion. And, truly understanding, the working capital safe harbor is so easily applied to real estate. Trying to understand how that applies to the small business, what is ordinary in a startup. I would say the biggest piece of advice I would give for any of these is documentation. I mean, whatever you do, so much of this is about the optics. You want to ensure that, even if you have a startup, or you're looking at a startup, you're looking at these options, or you're looking at, you're trying to actively hire to meet the employee test, or, you are buying equipment that will meet your tangible property test. If you're in a business such that the income, or for some reason the employees aren't going to be in that location within the opportunity zone, you could actually blow some of your testing. Let's say you started and you had 100 employees, sitting right here in the opportunity zone. And, in the world of remote work, you add 200 employees. Your business is growing like crazy. You add 200 employees and none of them are in the opportunity zone. Well, you've now failed the employee hours and the employee wages test. So you better hope that you pass the gross income test or the tangible property. You know, tangible property, that one could be tricky because it's based, unless you're a manufacturing plant, if everybody has their laptop and, whatever small equipment they have, 200 of those computers are outside of the zone, you could have a problem there. So you have to be a little more conscious of what you're doing there. And now that is not to be said that it can't be done, but it's not as intuitive, I would say, as the real estate business.
What types of businesses might be best suited to fall within this incentive program, and be able to take advantage of all the, the cap game incentives, et cetera?
So I would say, it varies, but if you think about kind of one location, one group that is kind of working on these, they're setting it up so, they have the fund that's raising the money, and then they'll have a QOZB that's for a piece of property, and they will build a standalone building that maybe houses 7-Eleven or a Starbucks, but they did the ground up construction. So that's one QOZB. Then another fund will raise money and, put the operations of the 7-Eleven in that building, or, Sherwin-Williams painting. So that is great because it's being assessed at that site. A laundromat, that would be fantastic, because think about that's right there on site. It's although you don't have a ton of employees, all of the equipment is there. The revenue is clearly generated there, unless for some reason you're shipping if you have laundry services that are off site. But that is a great opportunity. Where it can get a little bit tricky, but you might want to think about is like if you have a management company. Let's say, I have a client that is looking at various opportunity zones across the state of Louisiana. So he is actually starting a management company in one of the zones to look for properties, to actively manage the construction of the properties that are being built and rehabbed, and then a property management component of it for some both OZ and non-OZ properties that they're working on. So it can be done. You just want to be very, very careful about how it's done, because that one I feel like it's a little bit easier to mess up the testing.
And what about something, a example that we've seen with clients? Maybe I think you had mentioned that there was a hotel client that you had, and some of the unique structuring you needed to do to make it work.
So we have a client that purchased a hotel, and these poor people, they closed February 22nd, 2020. So, bad timing for the hospitality industry and for everybody. But what they paid for the hotel, even with the land appraisal, the cost of the substantial rehab that would have been required would have exceeded the price point for the flag that they fly on that hotel. It's not a luxury hotel, but it's still the pricing did not, the cost analysis did not work. So what we actually did with that entity is or that plan was we created one entity that holds the building, and then we created another entity that is the management and operations of the hotel. That they have the employees, they paid for all of the furniture and fixtures, all of the improvements. It's actually on site and run out of the hotel. And we put in a 30-year management agreement. So when it comes time to sell the hotel, it's a package. It's the management company, because they're only doing the management and operations of this one hotel. If it was for multiple, that could cause an issue. But when we go to sell, there will be an allocation of the purchase price to obviously the land, the building, and then the success of that hotel based on the management operations. So that is something that, we kind of put in place, because otherwise the substantial improvement requirement would not have been met.
Gotcha. And so kind of bridging the gap between small businesses and real estate is kind of the venture capital funding, startups, et cetera. Can you kind of compare, contrast with some of the other opportunities we've previously discussed?
So this one's a little bit harder. We haven't seen it as much, but the idea behind it is fantastic. You're pairing some venture capital with your startups. The timeline and kind of the nature of venture capital and the turning and the cycles, they fit very well together. And again, the word opportunity. But if you think, okay, the venture capital, they infuse this money into this business. Now remember, it has to be a new business. It has to be in the zone. So there's a lot of boxes that need to be checked to make that work. But let's say they get that to work. Then when they actually go to sell, let's say at 5 years, they've grown to where they want to sell that, they can actually take the proceeds from that sale, and at the fund level, I'm getting a little bit of feedback, I don't know if it's me, but at the fund level, they can reinvest. So it hasn't caused any kind of issue with the investor's original holding period. And then to the extent that there's gain, there's quite a few options. And if we have a chance, I actually wrote an article about it, and I can try and drop it in the chat or kind of direct you to it. But there are various options for ways that you can continue to defer the new gain that was generated by that reinvestment. And the nature of the venture capital is that they're going to want to churn and generate these big investments. So it really is fantastic for OZ investors, that plan on a minimum of a 10-year hold. A lot of times the challenge may be that, unlike real estate deals, these deals, are going to have a much harder time getting debt financing. It's an operating business. A lot of times there will be personal guarantees. That won't provide as much flexibility to getting cash in the hands of the investors, which isn't necessarily a bad thing, but it's just something to think about, because in 2026, there will be a tax due. I think some of the earlier funds made some promises that there would be distributions in time to make those tax payments. We'll see. I think that all depends, but it will be harder with either the active trader business or the venture capital investment to get some of that debt financing without the personal guarantees. And without the personal guarantees, the investors won't have the debt allocated to them to give them basis to be able to get any kind of distributions tax-free or losses allocated to them and can use them in the current period.
Understood. So just kind of, we've gone through a couple of examples as we kind of went through the real estate and the small business and then venture capital, but like diving into some more examples, I think that's where people really kind of get the whole process in their head. I know we have a Arizona client that kind of brought together some of the local incentives offered and some unique structuring. Do you want to use that as an example?
Yeah, I mean, because I agree with you. I think this is where people are very interested. Remember, if you have questions, let us know. If you have a great example, we'd love to hear about it. But client in Arizona, the local government was really, really excited and really wanted to draw in some of this developer money. This was one of the very first OZ projects that I worked on. It, kicked off in 2018. The local government actually offered a long-term, and when I mean long-term, it was over 30 years, ground lease and a parking deck to the developer. The developer was then permitted to build mixed use and, so commercial on the bottom and multifamily on top. And I mean, that was a $14 million worth of land and structure that was basically given to their project. I mean, what kind of project will you get a $14 million basically capital infusion into your capital stack? It's not common. They also got a property tax freeze. So every little thing like that helps, with your return with the return to your investors, with covering some of the inevitable costs that are going to come up. I mean, it'd be great if construction went as planned. That one, of course, they got hit with COVID and then rising interest rates and supply chain issues. So they've faced a lot of challenges, but most surely that project could not have happened if it had not been for that big community involvement and investment. So let me see. I think we have, I think I mentioned this one, but the workforce housing with this client in Florida, that one, very favorable bond terms. They are building 5 different buildings, and actually at the end, one building will be given to the government, the local government. But they got basically free land. It's like, I think that one was a 100-year ground lease, and the government is doing whatever they can to move that project forward. It's very unlike typical construction projects that I've seen, where you're hitting a lot of red tape. You can't get the permitting, you can't get, the zoning. People miss very key deadlines because the local government is not involved and invested. I'm seeing the opposite on these projects.
And that seems to be something that, investors sometimes don't look at beforehand, is how how much the local government is really encouraging that kind of thing. Because, I mean, they can be a hang up at several different points. I mean, some of the opportunity zone timeline doesn't really work if you're following through a normal zoning procedure, whereas some of these local governments, they're not even, they might not be providing the tax incentives, but they're helping these projects get through the timelines much faster.
Yeah, it's been very nice and kind of refreshing to see. Another thing that's been really interesting, and this is a little bit of a departure from what we've talked about, but some of the early projects, when opportunity zone projects came out, or the opportunity zone regulations came out, people were looking to deploy capital. I mean, it was crazy. And we had some folks that deployed capital early, bought some great sites, and they have since gotten crazy offers. I mean, crazy offers. And actually, because the values went up so much, it actually precluded some others from moving forward with the plans that they originally had, because the price of land increased so drastically, it didn't work with their pro forma anymore. But one client in particular had several different QOZBs that held some land. It was either raw land or some very, very minimal, tiny little structures in place. And in several instances, they went ahead and sold those properties. And so what happened in that case, and I think we may have had a question about this, but what happened in those cases is there were various QOZBs. That money went back up to the QOF level. And remember, if it gets deployed from the QOF level, you don't have any kind of inclusion event. The investor still has their same holding period. They're not starting a new holding period as long as it doesn't exceed the original gain. And then they redeployed that into other OZ projects where they did need a little bit more capital. So it's interesting to see some of the dynamics and the actions that are being taken while trying to stay compliant, still maintain the 10-year hold period. And, even in that example, what some did is, let's say they had purchased the land for 10 million, they sold it for 15. Well, 10 million was the original capital that had come in. The 5 million of new gain, so the original capital then will, any gain that's associated with the original capital, they deployed into new deals from the QOF level. With one of the clients, what we did is the new gain of 5 million that we're using in this example was distributed to the investors. And at that point, they made a decision: do I want to recognize the gain? Do I want to reinvest? And what we recommended with that group was to start a new QOF or find a new QOF rather than having two different holding periods within the same one, because they would have had the holding period associated with the new gain and the holding period associated with the original gain. So that is something that people need to keep in mind. I don't know that they necessarily think about that when they're planning the exit. So, that one they did, where we had a family, a family office that had created the QOF. They weren't worried about the holding period. They weren't planning to separate or do their, go their own ways. So that in that example, with using that same example, they would have rolled over the 10 million, and then the new gain they also rolled over into a new project. So we just have two different holding periods for each investor in that deal.
So it sounds like with some of this structuring, it's really important to have somebody, have professionals that have really delved into these opportunity zones. It seems so straightforward, and then you start to dig into it. What are your thoughts there? Where have people gotten into trouble?
I cannot emphasize enough how important it is. Especially like little things like the two-tiered structure, so that you can rely on the working capital safe harbor. Or, we have one client that came to us because the CPA that was working on, they set it up, the two structures correctly, but at the fund level, they didn't check the box saying that, yes, they are an opportunity zone fund. So we're working through a private letter ruling on that one. And another fund, I'm not entirely sure. I don't know why the other firm did what they did, but it's a real estate project, so it should be pretty straightforward. They reported it correctly in year one. In year two, they said the land was not qualifying real estate property, and that it wasn't a qualifying asset. So they failed their test, their 90% test. It generated a $40,000 penalty. The client questioned it. The accounting firm said, yes, that's what it is. Again, I have no idea why. I mean, it truly is a ground up rehabilitation projects. But the problem with that is, so, we were brought in to try and clean it up. But for those of you that have dealt with the IRS lately, they're not the most, they're very timely at sending out notices and telling you owe money. But when you try to respond to those notices and say, here's why we don't, it is very, very difficult. And that one actually went to collections. We've been trying to deal with the collections agency saying, look, here's where we filed. We gave a cover letter, we did an administrative adjustment. Here's where we filed this in July of 23. And this was, the IRS had not processed it in April of 24. So now there's a collection agency threatening to put a lien on a client because the CPA firm didn't understand the testing rules and reported it incorrectly. And another thing that I would just like to quickly point out is at the QOZB level, there's very little about that return that would even indicate that it's a QOZB, that would indicate that there's more work that goes into that return than a typical return. Really, the only thing that you would see if you were looking at that tax return is a statement to the K1s saying what that investor's investment is at June 30th, assuming it's not year one, at June 30th and December 31st, and then the qualifying property. Hopefully what is happening behind the scenes, and I don't think a lot of people realize this and understand kind of why the fees are more than just a standard project is, behind the scenes, someone should be doing the testing. Somebody should be looking at that and saying, if it's a real estate project, is there a working capital safe harbor in place? Is this original use property? Are there any non-qualifying financial property? Is it hopefully, if there is it less than 5%? We have a very extensive process that's all behind the scenes. So people get a return and think, well, there's really not much to it, but there is. And that's at the QOZB level. And remember, as your prior instructor said, that if the QOZB doesn't meet the 90% holding period, that blows the testing for the QOF. So there is a lot riding on both of these returns. And then at the QOF level, you have Form 8996, which shows what you've invested, your qualifying business property, whether it's stock, a partnership interest, or direct investment in property. And that gets reported. You have to calculate if you've met the 90% test. And again, like that example that I used with a client where they deployed 90% immediately, but then they had $1 million earning interest. That one, they failed a teeny, but it wasn't a very expensive penalty. But that's where it's crucial that you work with your CPAs to say, okay, it's March, we have a testing period in June. What do we need to consider? It's year end, we have a testing period. What do we need to consider? Or there's new capital coming in at certain points. By when do we need to deploy that capital? It is so important, and we can't help most times if we're brought in after the fact. There's a lot that can be done proactively. Retroactively, it's not as easy. It's often impossible. So please, please, please work with experienced professionals.
Absolutely. Well, in conclusion, we'll move on. But would you summarize, we discussed the three different categories: the real estate, venture capital, and small business. If you put those in order, what are the best suited for opportunity zone investing, and which ones are maybe cause a little bit more struggles and getting sideways?
In my experience, the real estate ones have been a little bit easier from a testing, from a kind of a testing compliance, and from the capital raise perspective. A lot of the startups or kind of the combos, like the venture capital one, there's a lot where people don't understand, that it can't be sweat equity. They're not going to get the OZ benefits for getting sweat equity, for their sweat equity in their startup. That is a big challenge. A lot of what we do is simply education. You know, people will call and say, hey, I've got this business and an opportunity. I mean, I have somebody else that a client in Texas that has some farming, and they were like, oh, this is great. You know, we're getting all of these agri benefits, and we're going to layer this in, and we have this OZ business. And I'm like, well, but here are the issues. You know, they didn't have, they weren't funded with an OZ investment. You know, they were trying to figure out how to do that. Their income generated in the opportunity zone. I asked about it employees and where they were based, and they said wherever you tell us they will be. So you know, that can be a challenge. We have another client that has actually tried to set up a trucking business and management company kind of in the same entity. Trucking business has posed a lot of other challenges, you know, that the assets aren't being used on site. Then when you're looking at the employees, well, how much of the employees' time is generated for like the management, and where is that revenue being generated from? So I think there are more nuances than people really put thought into initially. But if you think standalone business, like if there's a pad of land that is near a college campus, and you know, somebody buys the land in a fund and they construct a building, fantastic. Somebody leases that space and wants to put in, much as I hate to think about my daughter who's a freshman in college going to like these little dive bars, you know, we know they're probably doing it, but or a Starbucks, better, they want to get Starbucks and muffins, you know, put that in near a college site. I mean, I think those are fantastic, and I have seen those, and those are exciting to me. But you know, we have to kind of wait and see how it all rolls out, you know, after 10 years.
Absolutely. I think we're coming to the end. I did want to point out that there are a couple more slides. We had a couple, you know, kind of deep dives into some definitions that I know Kat has mentioned throughout this discussion, but really felt like it was outside of the scope of this discussion. So we just left them in the back. So, you know, if you're you know, wondering about, you know, substantially improved, you know, she kind of talked about, you know, land versus building. You know, I know the working capital is back here, the valuation of the property, just some additional resources. If you had any questions on any of the kind of definitions that Kat has mentioned. But again, like if you have any questions, please feel free to reach out to either one of us. We have our contact information in here.
Feel free to reach out with questions. Like I said, you know, education is a big part of our job, and we really do enjoy it. So, you know, reach out and challenge us. You know, we enjoy it. Thank you for your attendance.